Hi, my name is Roy Rumbo. I am an adjunct accounting professor at the University of North Texas, and I am recording this class for the benefit of my students in Accounting 3110. That's the first intermediate accounting course. And I do teach the second intermediate accounting course too. Both of them, these are very difficult courses for accounting students. It's a hurdle to cross to make it to the end and to pass the Certified Public Accounting Exam, the CPA exam. So with that, I'm going to get started here. Today, we're talking about receivables, and we're also talking about uncollectible receivables, because we take risk when we offer credit to our customers, and we want to take risk because we want to sell a lot. It's kind of a balancing act. If we're too loose with credit, we can sell a ton of stuff, but we won't collect very much, and we'll end up, with no cash and lose money. So that's not a good scenario. And so, but if we're too strict with the credit, maybe we will reject selling to some customers that we maybe should sell to. So companies have credit departments, and they evaluate customers for their credit risk. They may look at their financial statements. They may do some Dun and Bradstreet reports to see are these customers paying other people, and look at the risk for these companies. With companies we consider low risk, we're going to want to sell them a lot, and we'll have very generous credit terms and offer larger credit limit. A credit limit is how much we allow you to carry in balance at any single point in time. If it's a new customer we don't know much about, we don't have a credit history with, or we hear and see bad things about them, we may take a gamble on them, but we'll offer them a lower credit limit, and we'll be watching that account very carefully to see if they pay or don't pay. So we look at the accounts receivable balance at any point in time. We know, based on history, that a portion of that is not going to be collected, and we have to reduce our accounts receivable balance, and we have to record an expense, what we call a bad debt expense, an uncollectible account expense. Now, at this point in time, we don't know which customers are not going to pay us. So therefore, we use a contra asset account called allowance for uncollectible accounts. Now, it's contra because it offsets the accounts receivable, and we net the two for the balance sheet. We show accounts receivable on a net basis. And I would say it's also called a contra accounts because it's contradictory. Assets have debit balances, right? However, the allowance for doubtful accounts has a credit balance, because inside of assets and offsetting receivables, and it reduces receivables because there's an amount, accounts receivable net to reflect how much we believe net realizable value that we're going to collect those accounts in the future, and we're not going to collect 100%. So today's part of the lecture, I already did a whole lecture, an hour and 20 minutes or something on this whole subject. So you can watch that if you want to know more, or if you want to, get some good sleep, maybe, however that works. But today I'm going to work some, allowance for doubtful accounts problems. Just keep in mind the purpose here is trying to estimate, maybe a better word is guesstimate, how much we're not going to collect them. Again, we use historical experience to do that, but there's a couple of methods we're going to look at today. I will say that the balance sheet method, the aging of the accounts receivable, is the better and the more preferred method, because it does evaluate and looks at the balance sheet directly. So with that, I'm going to share my screen, and enough talk. Let's get to work here. And so this is in class problem number 1. So the Reentry cosmetic company sells products on a credit basis, and this is one thing that's important. They only record the adjusting entry for bad debts one time for the whole year on December 31st. And so we're going to have activities for the whole year here in front of us, and we'll record these journal entries. Now, at the end of last year, 2020, the receivables, this is on the balance sheet. This is what the line item would look like. Receivables, net of the allowance for uncollectible of 30,000 was 435. So right off the bat, and I'm going to do a little T count here. You don't see this, but I'm going to move my face up here from the zone. I'm going to start over here with a T account for accounts receivable. And so what's the beginning balance of accounts receivable? It's 465. And I'm going to do this in thousands, right? Because 465 minus the $30,000 allowance equals the 435. But in my receivable account, I've got 465. And then my allowance for uncollectible, I'm going to just, well, I won't be doing it, but I will maybe in future in the other two problems, is got a credit balance of 30,000. Last year, and when we examined that $465,000 credit debit balance for AR, we decided, hey, we're not going to collect 30,000 of that. We're going to have some problems, you know, so, which is pretty typical, 30,000, that's, I don't know what percent, that's not a really large percent there, less than 10%. So number one, I'm looking at what we need to do here. Here's all the data we need to use. Number one, we got to prepare the journal entries for the 2021, the write-offs and the collection of the receivables and all of that. So what are the journal entries we're going to do? Number one, we've got credit sales for the year of 1750. So we're going to debit accounts receivable. Again, I'm going to abbreviate that as A/R. That's how we do it in accounting. It's $1,750,000. And I'm going to credit my allowance for uncollectible. No, I'm sorry. What the heck am I doing? I'm going to credit, that would be a very large allowance, the whole thing. Revenues, what am I doing? $1,750,000. And then during the year, we collected cash from customers. So debit cash, that's an easy one. Increase in cash is a debit, $1,830,000. And that's a reduction in AR of $1,830,000. And then we wrote off accounts. Now, when we write off an account, we reduce the receivable and we reduce the allowance. In other words, these are accounts that we previously estimated were going to be written off. Now we know which ones, and we're taking them off the books. You know, maybe they went bankrupt. I don't know what happened. By the way, we spent a lot of time trying to collect this. There is a big lag here. You know, in the companies I worked at, we spent 6 months trying to call them, collect them, do whatever we can. You know, and then suddenly turn it over to a collection agency, and they'll try to collect it. And we've gone through all that now. And these accounts, they're never going to pay us. It's over. So we're going to reduce the AR. How do we reduce? Well, we're going to reduce the allowance. Let's do the debit first. It's a credit balance. So we're going to reduce the allowance for $35,000. And we're going to reduce the AR for $35,000. Because kind of think about this as a liability. We set up, it's not a liability. Let me just say that it's a contra asset account, but kind of like that, we increase it with what we estimate in the future to be write-offs. And now we actual write-offs. And so we will come back and reduce that balance. And let's go ahead and this is all the journal entries we need to do for the year until we get to our bad debt expense. So now we're going to work on that. Let's post these entries. So we got 465 plus $1,750,000. I'm just doing my T accounts here for AR, and I got another $35,000 credit there. So what's my final balance in AR? It's 465 plus a debit of 1750 minus a credit of 1830 minus a credit of 35, and I get to $350,000 debit balance. Now, my allowance account, very interesting. It has a credit balance for now because I haven't done my adjusting entries yet, because some of that 350 is still not going to be collectible, and we're going to have to figure that out. By the way, these are kind of these are except for one entry, these are all the entries that we'll ever talk about in these chapters. We're going to debit AR and credit revenues. We're going to be paid by our customers, debit cash, credit AR. We're going to write off accounts. And then the fourth entry, and the only four entries, we are going to record our bad debt expense and our allowance for doubtful accounts. So we'll do that once we know the number. So there's only four entries around accounts receivable that you basically need to know for this chapter. How easy is that? Number two, okay, we're just going to use the percent of sales method. This is not the preferred method. And so, in fact, it used to be an allowed method, but the FASB has come back with the, you need to now examine your receivable accounts and your notes receivable accounts to see what can be collected. And so you need required to use the balance sheet method. But some companies will use the percent of sales method during the year for their financial statements. At the end of the year, they would use the allowance for doubtful accounts, kind of combined. But for your audited financial statements, you'll have to do something like the aging method, which we'll see in B. So 2A is easy. The percent of sales method is very easy. We just take revenues of 1750. Again, I'm doing this in thousands times, we assume, hey, 3%. It's going to be bad. So 1750 is going to be 52.5 thousand. Again, these are thousands. That's actually a million there. 0.5 thousand. So here's my entry. See how easy this is? Bad debt expense. $52.5 thousand, and credit my allowance account. $52.5. Now, what's my ending allowance? It's going to be, so now we have a credit sitting over there, 52.5 minus a debit. We can just do it here if you want, 52.5. And so I've now got 47.5 thousand. What is my AR? Equals 350. This will be what will be on the balance sheet, minus 47.5. $302.5. That's what we'll see on the balance sheet for AR. Again, easy method, not really the allowed method, by the way, so that's a problem. And so next, we're going to do, and we'll look at number B here. Bad debt is estimated by adjusting to the ending balance based on the aging method. And this is a really good method that a lot of companies use. And so let's look at this. This is 2B. And so we've got 0 to 60, 61 to 90, 91 to 120, and 120 days plus. So this is an age. If we look at each, we really, accounting systems will do this for you, but we run a spreadsheet or a query that we take all of our accounts and we age them out. So we get a report of all the dollars amounts that are 0 to 60 days old, meaning we've shipped them the product within the last 60 days, and this is the total balance. So we see here that that's, for us, that's 65% of our total is the receivables only 0 to 60 days old. So that's probably going to be more collectible. As we see, we deem only 4% of that be uncollectible. 20% of our accounts, hey, they're starting to get a little old. They're slow payers. and 10% are even slower, and 5%, okay, deadbeats. they're not paying us. So you would think a higher percent of this might go uncollectible. I see in this certainly a textbook example when it says 40% of this only is going to be uncollectible. A lot of times that gets up to more like 90%. When they're that far behind, there is a problem. So 65% of the receivables, which are 350. So we'll see what dollar amount is in each of these buckets. Now, I'm lucky because I have a little bit of a cheat sheet here. So I'm going to not do my calculator. 227.5. 20% of 350, 70. 35.0 and 17.5. Now, by the way, if you total all this up, it's going to equal 350. We've taken our total accounts receivable and we've aged it. And so now we know, hey, based on history, and this company must be really good at collecting deadbeat accounts, right? Because they still collect 60% of them. Only 40% of this over 120 days is going to be uncollectible. That's pretty interesting. And so let's just do these numbers here. So this is very small because these are more current accounts. Only 4% of that is deemed uncollectible based on history. This is getting a little bit slower, 15%, 25%, and 40%. So when you get to the exam, this is going to be a lot of math here. 9.1, 10.5, 8.75, and 7.0. So in other words, let's just think of this: 17,500 dollars of accounts receivable is over 120 days old, and we believe 7,000 of it will not be collected. Now, the company must be pretty good with these old accounts and based on historical practice, because they are going to collect, they believe, 10,500. Again, these are all estimates at this point. So we add up all the uncollectible accounts and we get to 35,350, again, in thousands. Now, what's interesting about this is if we think about the allowance account, I'm going to do this on a T account basis. Hope I don't run out of room here on this piece of paper. I guess I got plenty of paper. Remember, and I'm just going to take the final balance we had was 5,000, and it was a debit balance. And guess what? Now we know the final answer. This balance should be 35.35. In other words, we've calculated out how much of our 350,000 will not be collected based on our best estimate, based on very, very educated guess, based on knowledge and data around our receivables. We get to this amount is our best estimate of what will not be collected. So that is what needs to end up on the allowance for uncollectible accounts. Different than the percent of sales method, because we just book entries into that allowance. That's why I don't like it. And you don't know at the end of the day, we ended up with 47.5, using the percent of sales method on the same company. But yet, maybe that would have been too much looking at this aging. And so the balance sheet method is a better reflection of what's happening at the company and the better estimate. So this is what the FASB prefers now. So how do we do our journal entry? We know the allowance needs to be 35.35, but I'm sitting there with a 5.0 debit balance. Simple algebra. What credit do I need to put here to make a $5,000 debit become a $35,350 credit? Well, that's pretty easy. 40.35. So my credit's at 40.35 minus my debit of 5, 35.35. So that is the solve for X, if you will, which makes this example a little harder, but I would say the effort in the company side is worth it to get to the right answer. Otherwise, we would have booked too much. We would have booked $52,000 of bad debt expense using the percent of sales method, when the more correct answer would have been 40,000. So our entry, debit, bad debt expense, 40.35, credit the allowance. For uncollectible, 40.35. Ending balance in AR for the balance sheet is going to be 350 minus 40.35. Oh, I'm sorry. I knew there was something wrong there. Not 40.35. The ending balance of AR, don't make the same mistake I was going to make, because I was just going to pick up that 40.35. That is the journal entry. That is the expense. The ending balance is 35.35. So the ending net balance in AR is 314.65 thousand. Which now I've answered number 3 in each of the situations A through, there used to be a C, I deleted it. For each of the situations in A and B, what would be the net amounts reported? It would be the 302.50 for the percent of sales method, and the 314.65 in the aging method. All right. Next problem, that's 1. Problem 2. In class problem 2. All right. Again, this would be a good time to pause the video. And I've got the problem up there. Let's see if you can see the whole problem. You're looking for the same things. You can't see C there. I think that's the whole problem right there. Let me make sure. Yep. So it's a December 31st. All the same things we just did. Here's the data you need. So you could pause the video right there and go work this problem. All right. Hopefully now you're back after pausing the video, and let's see if you got the answer right. Okay. And I'm going to work a little faster this time, because hopefully you're getting this down pat now, and a lot of redundancy. Sometimes I will say redundancy is a bit of teaching. You do this problem with me 3 times, you practice it, you will learn, it'll be internalized. So when you get to an exam, my students will get to exam, will see this almost exact same problem. When they get to the exam, practice that, boom, you'll knock it out. You won't be one of those students panic in the last 5 minutes trying to knock it out, because you'll do this so quickly during the exam. And you, by the way, will get it right. Now, I wouldn't go too quick when you're doing an exam. Go at a methodical speed. I tend to go too fast and make mistakes. I hope that's not you. All right, I'm gonna do the same thing I did last time. I'm gonna go ahead and start with my T accounts. And that's one good thing about practicing a problem like this. you can find your own strategies for how you want to organize your piece of paper there, for your scratch piece of paper or the piece of paper with the answer on it. And so that might make it better for you. So let's just do the journal entries, debit AR for 3,500,000. I'm going to do this again in thousands, just to save paper here, and credit revenues. And then I'm going to debit cash collections, debit cash, 3,750,000, and that's a reduction in AR because now people that owed us have paid us. And the last entry, and these are some, again, there's only 4 entries we're ever going to do in this part of this chapter, and we're going to write off receivables of 25,000. That means we're going to reduce receivables and reduce the allowance. I'm just going to call it the allowance here, and that's 25. And I'm going to credit the AR for 25. Let's go put these in the system here. So AR, and I'm looking here at the top, starts, the net is 675, but that's net of the allowance. That's what showed up on the balance sheet. What we're really going to have here is 750 debit and AR, and a $75,000 credit and allowance. Again, that's how we ended last year, and that's what's sitting in our books right now before we book all these journal entries. So let's go post these. Debit the AR 3,500, credit the AR for 3,750 in thousands, and then we're going to write off these AR 25 and 25. So right now, before we do our allowance for doubtful accounts entry, our bad debt expense entry, we're sitting with 50 in the allowance account and 425. I believe this is 475 here. I'm just going to check my math in my spreadsheet. Don't want to make a mistake. On YouTube. All right, yes, 475 is the correct answer. I just added my debits and subtracted my credits, and there's my ending balance in AR. Number 2, percent of sales method for bad debts. Easy. My sales were 3,500 times whatever percent I believe is the appropriate percent based on history for this example, times 0.5%. And that's equal to 17.5 thousand. Again, check my math. Yep, 17.5 thousand. I put a K there for the thousands. So that's it. So there's the debit bad debt expense, 17.5, credit the allowance. Now, so we would put a credit there and we would have 67.5 thousand in allowance. You see how this is the income statement method, not the balance sheet method that the FASB prefers in their guidance, because I would have 67.5 thousand in there. What does that number represent? You know, because I'd have the percent of sales method every year, throwing numbers in there and writing off stuff. It'd be kind of a fuzzy balance, if you will. Unlike the balance sheet method, which we'll do next, we're going to go and calculate that. Now, let's just do this here. Ending allowance balance is going to equal to 67.5, right? Because I credit 17.5 there, got 67.5, and the AR net is going to equal 475 minus 67.5. equal to 407.5. I'll check my math again. But again, I'm answering number 3 already, which asked me for what would be on the balance sheet. So 475, 407.5. So that our balance sheet would say accounts receivable net of 67,500 in the allowance equals 407.5. Really kind of like this was what we said in 2020. This is what will be there for 2021. All right, aging method. Yes, there's more work in the aging method. So we're going to run a thing on our accounts. We got 0 to 60, 61 to 90, 91 to 120, and 120 days plus. 70% of our accounts are current. I would call that current. They're within the 0 to 60 day time frame. 15% have slowed down. They're, like our terms were 60 days. These guys are past due already. That's a problem. 8% are 91 to 120, and 7% are 120 plus. So just take that times our AR balance. Okay, 475. $330, $250, 475, 71.25, 475. 8% of that equals 38, and 475 times 7%, 25. And that's all going to add up to 475. So in other words, we've taken this 475 and through the data that the company is available to us, we've been able to age these receivables out. It's not like fine wine. Old receivables are not good. They're not probably going to be collected. And I think the assumptions in this over here are much more, I created it, and it's much more reflective of the real world. So very low. We believe that 99% of these are going to be collected. They're current right now. These are slowing down. 20% still may not be collected. If we get out here, it's at 91 to 120. That's all. 70% and 90% of these are considered. That's more typically what I see. Now, you're going to have to do some data analysis based on your historical results to calculate these out. You'd have to support this. Remember, part of our, from chapter 1, accounting should be verifiable. So you can't just I know it's common sense, but you got to back it up with some data because otherwise your financial statements, you want this to be as accurate as possible, supportable as possible. And by the way, if you're audited, you want to provide your data to support this with your auditors as well. And that's really important. All right, let's just, take these out. 332.50 times 1%, 3,325, 14,000. Yeah, I'm still gonna use my decimals and keep it in thousands, but and now this really makes sense. Of this 33,000, it's 120 days old. These are deadbeats. 29,000 of that not going to be collected. That makes a lot of sense to me, a lot more than the first example. And then we add these up and we get 74.1 thousand. Again, look at our allowance account. Right now it has 50 That's this 50 that's up here. But we wanted to have 74.1. This one's a little easier than when we have a debit balance. So what do I need? What is solve for X? 24.1. $50,000 credit plus $24,100 credit equals 74.1 thousand. Entry, debit, bad debt expense for 24.1 thousand. Credit my allowance account. AR net equals the 475 from here minus not that, this. That's our ending balance in the allowance account. Minus 74.1 equals 400.9 thousand, 400,900. There you go. A problem two. One more, and we will. I will go see if I can find something for supper. I don't know where you are at this point. Probably could be in the middle of the night. You're like my son. So here you go. In class, problem 3. Pull this up. We don't need that line item. All right. I think you can see all of that. So this is a place where you could pause the video and you could go work this on your own. All right. Hopefully now you've worked it. You figured out this, you've got it down. And, you know, if you're really confident, you could say, you could go celebrate on your own, have breakfast or lunch or supper, whatever time it is for you. But not for me. I've got to work this here. And so let's do our same process here. Good to have a common process to work these problems. This is allowance for uncollectible. What's my beginning balance? Well, net, I had $1,000,001 on the balance sheet for accounts receivable. Yeah, but I had $100,000 allowance for uncollectible. That's a credit balance. So I must have had $1,000,002 in HR. All right, let's go do our journal entries from number 1. Debit AR. We did $5 million of credit sales, credit revenues. We collected cash, $5,500,000 credit AR. And we wrote off $50,000 of receivables. So we're going to reduce the allowance for 50, and we're going to credit and reduce the AR for that same 50. Let's go post these. $5 million of credit sales, our cash payment, $5,500, and write off the AR 50. Our final balance in AR is $650. Check the math of that. 1,200. Beginning balance plus $5 million in credit sales. Hold on. $1,200. Then cash collections of $5.5 million, and we had to write off 50. So 650, that's correct balance. And then allowance, that's a little bit easier. 100 minus 50, we've got 50 in the allowance. And this is before we do our adjusting entry. What's our adjusting entry? We're looking at bad debts. Again, number 2, easy. Percent of sales. I hope you have some multiple choice on this. Percent of sales method. Okay, 5 million in revenues times what percent of sales? Bad debt expense is estimated at 1.5%. That's 75,000. Therefore, debit bad debt expense 75,000. Credit the allowance account for 75,000. What's our ending allowance account? Is 50 plus 75, 125. What's our net AR? Equals 650 minus 125 equals 525. So what we're saying again there is that of this 650, we're telling our financial statement users, hey, we're only going to collect 525 of that. That's how much we're going to realize out of that 650. Faithful representation of the numbers. All right, the balance sheet method. So we're going to now look at those 650, and we're going to do some data analysis to see from the balance sheet side, you know, a guesstimate, if you will, of how much that'll be collected versus just a percent of sales. To me, that's just way too fuzzy, percent of sales. Easy for an exam though, so I know that you might like that, but not the best method. So we got 0 to 60, 61 to 90, 91 to 120. These are days, and then over 120. And for this problem, these are 75% of our receivables are current within that time, 0 to 60. 15% are 61 to 90. 7% are really getting old over 90 days, and 3% are, you know, deadbeats, if you will. So let's go find out how much balance, dollar balance of the 650 is in each one of these. Where did I get the 50 from? That's what's in receivables at the end of the year. So 75% of 650, 487.5, 15% of 650, 97.5 thousand, 7% of 45, 500, 7% of 650 is 45,500, and 3% of 650 is 19,500. By the way, this better equal 100%, right? Because you want 100% of your receivables in this calculation to make sure, back to completeness from our chapter 1, 75, that's 85, 90, 97, 100%. So that equals 100%. And if you add these up, they're going to equal the 650. So we've got every dollar in our 650 has been put in one of the aging buckets here. And so now we look at past history. So this is kind of a good example of completeness test. Do we have all the complete information to record this? All right. We know that here, I'm looking at this, what percent is uncollectible for each of these categories, 10, 50, 60, and 90. So let's go calculate this out. That's going to be equal 48,750 50% of 97.5, just a coincidence that these equal, only a coincidence. 60% of 45.5 is 27,300. And 90% of the 19.5 is 17,550. Add this up, it gets to 142,350. All right. Again, look at our allowance account. Right now, it's sitting with 50. What do we want it to be? Based on the data we've looked at, there's 142,350 that will not be collected. So that is what needs to be reflected in the allowance account and on our balance sheet. We've got 50 there. What credit, solve for X, equals that it'll take 50 up to 142,350. Well, that's just 142,350 minus 50, 92,350. Entry, debit, bad debt expense, 92,350. Credit the allowance, 92,350. That goes to the income statement. Ending net AR equals 650 minus the allowance account, the ending allowance account, 142,350, and that's equal to 507,650. When I check my math, $507,650. There you go. Well, guys, I'm gonna stop this screen share. That's hard work. You know, I just did 3 problems here, and hopefully that sets you up. Again, it is practice. It is doing these problems on your own, not just watching me. How boring. Do these problems on your own. You have to practice. Accounting takes practice, but as you practice, you will know it. And so that's why you can't wait till the last night before the exam. Please, my friends, do not do that. And I thank you for bearing with me for this time, and good luck on this chapter.